Hi guys, welcome back to another session. If you missed our last session, it was only an hour ago now, but it was the Darwin explanation session where we go over what is a Darwin and how it benefits you as a trader. Now, this session is more focused on actually using your Darwin or your Darwinex Zero account to develop as a trader. So if you've not been to one of these sessions before, what we do is I generally pick on somebody from our Discord community. So anybody who's in the Discord stream right now, if you want your Darwin to be analyzed, please just send it into the chat. I'm going to open up the chat so we can see anything that comes through. But we take a deep dive into the metrics behind somebody's strategy. I analyze it from a data perspective. Before I became a trader, I was actually a data analyst. So I love looking for patterns in numbers and patterns in, or like repetitive behavior patterns. And we tend to look at variables that, you know, not many traders look at when they're trying to build a technical system. So I'm going to ask again, anybody in the Discord stream, if you want your Darwin analyzed, please put it into the chat box. I believe Unscripted, I believe you asked me to analyze your Darwin the other day. If you did, please send it and I'll take a look at it. If anybody else wants theirs looked at, I'm more than happy to pick on any one of you guys. So yeah, I'm going to give it a moment for somebody to send their Darwin in, because I could analyze random Darwin. It's mine that you're seeing on the screen right now. This is my Darwin that I trade. I basically swing trade this, you know, I more position trade. I'll just take positions over an extended period of time, but I'm not too frequent on it. I could look at mine, but I don't think it's beneficial. I'd rather do somebody's who's actually here so that they can take something away from the session. Perfect. Thank you, Unscripted. I will, in fact, what I'm going to do, Unscripted, I'll take a look at yours on Darwinex Zero. Anthony, I'll take a look at yours on Darwinex. In fact, let me check how long your records are. Because what I do usually ask is that we have a sufficient amount of data to actually look at. So generally, I say 6 months is perfect. 3 months and under is a little bit difficult. Okay, this is probably going to be a really good one to look at. I'm just going to zoom in slightly because for some reason that's a bit more zoomed out. So at the moment, we're looking at a record from one of our traders in the Discord community. So what I'm going to do is I'm going to go through all of these metrics and just take a look at things that generally they can improve on. I'll abuse you, Anthony. Don't worry. Actually, from memory, I think I've got you bookmarked anyway, and I think you perform pretty well, so I won't have to abuse you on anything. But this is going to be from a completely unbiased perspective. I don't care how you trade. I don't care what you trade. All I care about is looking for patterns in your behavior or things that you are doing to see if we can find any low-hanging fruits to kind of exploit and improve moving forward. So Unscripted, it'd be great if you could tell me whether you're a manual or an automated trader, i.e. do you take positions manually or do you get an EA to take positions for you? The only reason I ask for that is because I kind of change my feedback based on whether you're a robot or a person. 100% manual, perfect. It's a lot easier to provide feedback to manual traders than it is to somebody using an expert advisor. A lot of the times people buy an expert advisor, you know, off the you know, the open market, and therefore they don't have access to change certain things when it comes to execution or, you know, risk parameters. So it's easier to look at it this way. So, okay, firstly, you know, you can see you've had a bit of a tough time. You've been working since September and currently down. Now, it's kind of great, really, that you're here and having your strategy reviewed. Now, I know that we had a conversation the other day and it's on my kind of to-do list, but we're getting around to it today. But the fact is you haven't restarted, you haven't left, you're still here and you want to improve, which is great because we've now got, I mean, September, well, let's not class September because you started at the end of September, but October, November, December, January, February, March, we've got almost 6 months worth of data to take a look at, which is great because we can really, we can with 6 months, I would say we can accurately put things in place, or at least have enough data to justify any amendments or improvements that we want to put in place. Okay, so yeah, start of 2025 has been pretty rough. You actually ended 2024 up, albeit slightly. You know, you was only trading for 4 months or three months, just over. But the start of 2025 has been rough. I also have found the start of 2025 rough. Markets are being, you know, more volatile than usual, with Trump coming into power, introducing all these tariffs, the stuff happening with Ukraine and Russia, and all that sort of stuff has made the markets a little bit more volatile. So we have to try and adapt. We have to learn from mistakes, and we have to try and implement things as soon as possible without jeopardizing the systems and the strategies that we have in place right now. Okay, so you trade primarily FX, but you also dabble with some commodities. I'm presuming it's gold. Okay, so 6 trades on gold over a 6-month period. It's not really enough to take a look at, but we can generalize with the FX pairs. Let's take a look. 50. Okay, so my first glance at this tells me that you have much less of an edge in FX than you do in commodities. Now, of course, we literally have 6 trades to go off on commodities, but if we look at your trade frequency, you're super infrequent anyway. So you've had 24 trades over a 6-month period. You know, so we kind of have to use time as a commodity for you as opposed to trade frequency, because you clearly don't trade very often. But if we just look at asset class as our variable in this situation, you've had 18 trades on FX pairs and you've won less than 30% of them, right? Now, to me, I always say there's 2 sides of a fence, and the guys who attend these sessions regularly will also back me up. I say this every session. You have 2 sides of a fence when you're trying to develop as a trader. You have the left-hand side is where you're trying to generate more winning trade ideas. Now, what this means is I generally say if you have under 50% strike rate, you have work to do, because if you're under 50%, then generally you're wrong more than you're right. And whilst you can make money that way, and I'm not disputing that, it's going to be very, very difficult long-term to keep up a low win rate strategy, you know, especially when it's not proven to be profitable over an extended period of time. It's going to be really difficult to make that work for you. Now, if we can try and increase the win rate here, which is, you know, we're going to go over some things to see if we can do that, then you can work on the right-hand side of the fence, where you optimize trades at a, you know, a granular or individual level. So you're looking at individual trades. How could I have ran this more? How could I have reduced the drawdown? Could I have taken multiple entries? There's so many things that you can do, but I think before you waste time looking at trades, you know, kind of on an individual level, you actually have to answer the question, well, am I taking enough winning trades to optimize? Because I would argue if you're losing, which you are on FX trades at the moment, if you're losing 73% of the positions, I wouldn't be concerned about optimizing those trades. I'd be concerned about how do I get rid of a load of those losers and how do I generate more winners, especially when you're so infrequent. The infrequent trading could be a benefit for you because there's not too many trades to go over. So it might be really easy to identify what goes wrong and what goes right. Now, on the flip side to that, it's not all doom and gloom, because if we're looking at your trades on gold, you've got almost a 70% strike rate. Now, again, there's 6 trades over 6 months, so it's really difficult to say, oh, we'll just drop all the FX pairs that you're trading and purely trade gold. But there's clearly something different, whether it's you get more in flow with gold, whether you read gold's price action better, or whatever it is, however it is you trade, you're clearly doing something different on gold, because I don't think there was a single FX pair that had even near that win rate. 50-50. Yeah, so you had 50%, the highest strike rate or win rate you had on an FX pair was 50%. Gold, you've already way surpassed that. So what I would be looking at is taking a look at your gold positions, what you do, and then comparing it to your all the other assets. Okay, what's great, like I say, is that you don't actually have that many trades, so it won't take you too long. But compare not only the price action and the technical variables, but is there a specific day of the week you're taking these gold positions as opposed to euro dollar or whatever FX pair you trade. You need to understand why you're performing on gold and why you're underperforming everywhere else. Because when you're trading FX, you haven't made money on any of the assets, but on gold you have. Now, it's argued by a lot of professional traders that edge in FX is really, really difficult to come by. I don't necessarily share that view. I trade primarily FX myself. I do trade equities, commodities, the bund. Like, I do trade a wide range of assets. And whilst I think you can be more frequent and active on other pairs, I do think the edge in FX is very unique, and it's unique to every single pair, but there is still edge there. However, we need to see if we can change your strategy when trading a Forex pair to mimic what you're doing when you're trading gold, because there's clearly a discrepancy. Now, moving on to trading time distribution. Again, this is going to be really difficult to judge purely because of the lack of trades. But generally what this does, it just measures your profitability during different trading sessions in the day. So as of right now, your only profitable session is the Asian session. What I should mention, however, is this does track opening and closing of positions and counts both decisions, whether it's an open or close, as one trade. So even though it says 24 trades, that's just 24 opening or closing of a position. So it's kind of measuring your activity in those sessions as opposed to the actual amount of trades. Now, it's difficult to say why the Asian session was profitable because you had 3 positions. In fact, I'm going to go out on a whim and say your record is going to be difficult to judge overall just because of the lack of trades. Like I say, we have time on our side. You know, you have been trading for 6 months, but I would argue here already, before we even get into the granular stuff, that you need a big overhaul. You need to be looking at what you do on FX pairs and really like, is that going to work long term? Is there an edge there? Or is it just that the fact that, you know, the previous 6 months have just been a really tough time? Because there is that also. But it's hard to judge anything from this because, you know, other than the Asian session where there's only been 3 trades, the rest has been unprofitable, you know, with a minus return or a negative expectancy in both the European session and the US session. Again, it's kind of the same story with the return distribution by day of the week. So this is another variable that I absolutely love. Not many traders think about this when they're kind of baking up a trading strategy or a system. And it's when is your edge more present? And you can narrow it down by hour of the day of the week, you know, whatever you want to think of. But the day of the week is a variable that I absolutely love. And the reason I love it is because sometimes it can be edge related. So for example, if you're trading a mean reversion strategy, which I do on FX pairs, I like higher time frame mean reversion trades. They occur on certain days of the week more often than they occur on other days of the week. All you have to do is study, okay, what day of the week over the past 3, 5, 10 years has presented the high or low of the week more often than the others. If on that day of the week you're looking for a mean reversion trade and price runs into a nice level, you know, you have a higher expected value than on, let's say, a Monday or a Tuesday when you're trying to fade a move, but generally Monday might cause the low of the week and you're trying to go short. I probably butchered the way I explain that. But it can be edge related, but I think there's a lot of this that comes down to the trader themselves. So generally, I mean, I'm a creature of habit, so I usually do the same thing every single day. I work from home, so my routine doesn't differ too much. But if you're working a full-time job, a part-time job, if you do shifts, if you have children, you have to take them to school, you know, you drop your partner off at work, whatever it may be, you might do something on a specific day of the week that you don't do on the other days. So for example, let's say every Wednesday you leave work early and you go and play paddle with your friends, or you go down to the pub and you notice that on a Wednesday, your performance drops. I'm not saying it's a direct correlation with what you're doing as in going to the pub, but if you start wondering and going, well, every time I'm at the pub, I actually take a trade before I get there. I have a few beers and I mismanage the positions. Again, this is all hypothetical, but it's just about finding the pattern in your behavior as a trader when looking at the specific variable, which again is the day of the week. Now, I'm not going to spend too much time on this because, again, there's not too many trades, but you clearly, I mean, I don't want to say you have more edge on a Friday because of the lack of the trading days. But if we look at your Friday trades compared to your Thursday, which is your least performing, or your worst performance, sorry. So on Thursdays, you've lost almost 6%. On Fridays, you've actually made 2.5%. What you can do, again, it helps if you have more trades. Study your positions on a Friday and compare them to your worst performing day. Why is there such a discrepancy? Because if you're trading the same technical variables, as in your edge is the same, or let me break that down even more. If you break your trading strategy down to one common denominator, it might be a technical pattern, or I trade, I take a position after CPI, for example, or a news event, whatever it is, break it down to one common variable that is present in every single trade that you've ever taken. Look at why that variable works in some instances, but it doesn't. Because what you'll find is you'll have a different expected value within each separate variable. So you might say as a collective, my edge has a 60% strike rate, overall. But then when we break it down by these niche variables, i.e. day of the week, you might find that on a Monday, you have an 80% strike rate. On a Tuesday, you have a 40% strike rate. But then when you average that out, it comes to 60%. So the reason this is so important is because you can introduce, and Lance Briegstein talks about this. If you guys don't know who Lance Briegstein is, I highly, highly, highly recommend going and taking a look at his stuff, his work. He's a fantastic trader, and he talks about this a lot. And it's implementing a risk barometer. Now, it's quite an advanced tool, I would say, or an advanced way of looking at things. And not a lot of traders, or retail traders, I should say, like doing this. But I think it's a phenomenal way to capitalize when or strike while the iron is hot is the saying. And it's implementing a barometer where we go, okay, my standard risk is 1. That may be 1%, but in this argument, we're just going to call it 1. Now, if we identify where our edge has a higher positive expectancy, for example, in your case, it's on a Friday. So you clearly make more money in a Friday on the Asian session in gold. Okay. So if you have a trade that presents, if your pattern or your variable, your common denominator, which is present in every single trade, if that presents during the Asian session and it's on gold and it's on a Friday, your expected value is way, way, way higher than if it was on I can't remember one of the FX pairs that you haven't won a trade on. If it was on, let's say, Euro Swiss, for example, during the US session on a Thursday, that you have a negative expectancy in all 3 of those different variables. So even though it's the same technical pattern on gold on a Thursday, or sorry, on a Friday in the Asian session, compared to the US session, Euro Swissy trade on a Thursday, the pattern is the same, but you have a different expected value on both of those trades. Now, you should be looking to ways to optimize your risk to both of those positions. I'm not talking about risking 10x on the one trade and barely putting any size on the other trade. I'm not sure as well if, can someone confirm to me in the Discord chat that it's working, because I keep seeing it flicker and I'm not sure if it's just not working for me. Rob, if you could put a message in the Discord chat, I'd really, really appreciate it. Or Sorrow Trades. Okay, perfect. Thank you. I could just see it flickering. I didn't know if people were putting messages in and I couldn't see it. Thank you for confirming. I'm talking about, okay, 1 is our baseline on the risk barometer. On the trades where we have a higher expected value, let's push that risk up to 1.1, 1.2x, 1.5x even. So whilst you might be risking 0.5% or 1% per trade, when the iron is hot, when your expected value is far, far higher, you bet more on your position sizing. When you know that never mind, Rob, it just looked like the Discord chat wasn't working on my end, but thank you anyway. When you know that you have a less or a negative expected value or a less of an edge, you reduce your risk. So instead of risking a baseline of 1 or 0.5, 1%, however much it is, you risk 0.5, 0.75, and we make the slight adjustments. That way you're still getting the exposure to the market, but you're treating every single trade by considering all different variables. And I love doing this. It is quite advanced because you have to kind of think at a more granular level when you're taking a position. Okay, where do I fit on the barometer? Do I have a higher expected value? Do I not? But if you think to, let me I'll write it in for you, Gazebo. Gazebo's just asked in the Discord, how do you spell Lance Breakstein? I might have got the E's and the I's wrong in his name, but that's if you Google him, he'll come up. If you think about poker players, okay, they're very similar to traders in the fact that we're making careers out of the value of our best guess. Now, what I mean by that is, and not a lot of people like it when we say this, but we are just gamblers, right? We are taking positions and we're risking capital. That is defined as gambling. Now, we can have an edge, and poker players also have an edge, but when their edge is present, when they have a better hand of cards, what do they tend to do? They bet more on that hand because they know they have a chance of a higher payoff. When their hand's awful and they've got no playable cards, or they know that there's a higher chance of them losing, they'll fold. They'll take the loss, they'll fold, and they'll move on. Yeah, thank you, Sorrow Trades. That's his Twitter, or his X account, I should say. So you've got to think of yourself like a poker player. When your hand is good, try and push the risk. Again, not in an aggressive or reckless way. Just try and play the odds. When you've got an awful hand, you fold or just reduce your size. If you had more trades, specifically unscripted, I would be saying you should be dropping this session. You should be dropping that asset. But right now, we don't have enough to accurately say, yes, you should be doing this. Before we move on, I'm going to do Anthony's as well. UPRH, because it's going to give us a bit of a different view. Because I think you've got a much longer record, if I remember right. Okay, so your record is since July last year. Yeah, great record. Great return, controlled drawdown. Love to see it. Okay, so again, let's take a look at the assets that you trade. So commodity CFDs, you've had 83 trades, 82% strike rate. Like, that's just phenomenal work. You are on the right side of the fence. You can start looking at how to optimize individual trades, in my opinion. You don't need to be worried about how to get more winning trades through the door. And indices, you've got 75% strike rate. And then on FX, you've got an 85% strike rate. Like, you are set up in a fantastic position now where you don't have to worry about your trades. Your trades are working. Your only job is to manage the risk. But you're clearly trading a system that has a positive expectancy. Now, how do you improve that? You don't need to get more winning trades. You don't need to get rid of more losers, right? You should be happy and content with your strike rate. Now we start optimizing trades on a granular level. How do I squeeze as much out of my winners? How do I mitigate my losers, if at all possible? But this is really great. I mean, you've got me a little bit envious, to be honest. I like high win rate systems, but this is great work. There's not one single asset, and I mean, you don't trade a lot. You trade pound, yen, crude, gold, and the Dow, and you haven't got one asset that has lower than a 75% strike rate. So, you know, kudos to you, dude. Keep this edge and protect it within an inch of your life, because it's clearly working. And just to say, you don't need to optimize your system. You're already doing good enough yourself, but there's always room for improvement, no matter how experienced you are as a trader, no matter how many trades you have, or you know, what you're doing. There's professionals who've been doing this 20, 30 years who still spend hours a day working on their edge, you know, journaling, figuring out what they did well, what they didn't do so well, always with the same end goal: how do I improve and how do I make more money? Moving on to your trading time distribution. So you can see, obviously, you're more active during the European session. So, which I already know, because I believe you're UK based like I am, which would, you know, obviously show why you're more active during the European session. Again, this does show the double amount of trades that you've actually taken, because it shows opens and closes. Now, what's interesting to me is that whilst you're more active in the European session, it's actually your least profitable. Now, it's not of any concern, realistically. If it was lower, if we were talking 1% or break even, I'd be saying you need to figure out why that is, because you shouldn't be trading the European session. If you're making all of your money outside of the European session, but the majority of your activity is during that session, you need to figure out a way to do less work for more reward, or the same reward. But the fact that you still made a decent return in that session, you know, it's kind of by the by. I wouldn't be worrying too much about it. Your outlier is obviously the US session. You know, you've taken half of the trades, so you took 30% of your positions during the US session, and double that during the European session, but you've outperformed by 1.5x of the return. So I would be, again, looking, do you have, or can you implement a risk barometer? Is there a specific reason why your trades were better during the US session? Again, it could be trader related. It could be the fact that your partner works at home with you and she natters away all day, and then she leaves in the afternoon and you get to focus, and therefore you trade better. It can be something so random, or it can be edge related. You might be trading session opens, and for the assets that you trade, whether it's the Dow or gold, whatever it may be, maybe that asset just performed better on the US Open as opposed to the London Open. Specific nuances like that, again, all play into your expected value on a trade by trade basis. So again, what I'd be looking at for you at this point is be going, okay, can I implement a risk barometer when my expected value is higher, i.e. during the American session or during the US session? You do have it slightly with the assets as well. Obviously, your worst performing assets is the Dow or the indices. You've got a lower strike rate, whereas on the commodities and FX side of things, you actually win a lot more. So if you've got a commodity trade, let's say you're trading gold or crude during the US session, your expected value is much, much higher, as opposed to a Dow trade during the European session, which would make sense because you'd be trading the Dow before the US Open. So again, it's trying to find patterns, and I can't see your journal. I can't see your individual trades. So I don't actually know if that's the case. Only you can answer this question and try and find a pattern between your trades. But if you can go through your journal, if you can try and look at all of these trades during the European session, correlate it to the strike rate on the assets, go, okay, well, X amount of these trades were the Dow, but I don't perform as well with the Dow during the London session as I do with the US session. Okay, so should I be risking the same between those two sessions on the same asset? Probably not, because my expected value is slightly different. Now, again, you're profitable on all different assets, all different timeframes, and I'm going to assume all different days of the week as well. So would you want to be going below that baseline of 1? Probably not, because you already have, you're still profitable all round sort of thing. So you could just implement a one-way risk barometer where you have baseline of 1, which might be the majority of your trades, but you're really good A+ setups. And I'm not just talking A+ from gut feel, where a trader looks at a chart and goes, oh yeah, this is A+. Why? Oh, because I feel like it. I'm talking about, the session you perform better in, the assets you perform better in, the days of the week you perform better in, whatever it may be, you can risk more on that position. Again, nothing reckless. Not saying you should be risking 10% on a trade, but at least pushing slightly harder, right? Again, being a poker player, when your edge is higher, push further. This is really interesting. Really, really interesting. I spotted this straight away. So if we're looking at the days of the week that you trade, this is a great example. You clearly do something different on a Friday, or your edge just is less prevalent in the market on a Friday. You need to find out which one of those it is, because if it's human error or human behavior, you can adjust that quite easily and you can account for that. If it's an edge related issue, well, you need to figure out how you overcome that. Or at this point, dude, I would be going, I'm just going to stop trading Fridays. It's clearly not working for you over an extended period of time. Like, your best day is a Monday where you've done 12.5%. You're positive on all the 3 other days, but your worst day is a Friday where you're actually down 5% over July. It's like a 9 or 10 month period or something, maybe 8 or 9 month. I would be actively making a change at this point. I'd be going, and yes, whilst this is, what's the word? Not hypothetical, hindsight. Whilst we are looking back in hindsight here, I'd be going, well, I've got 8 or 9 months worth of data where I can clearly see that I'm underperforming on a Friday. To ignore that would be silly. The least that you could do is just stop trading Fridays, in my opinion. That's the lowest hanging fruit, where you go, well, I underperform on a Friday. I don't want to know why. I'm just going to stop trading. I'm going to do less work for more reward. Cool. hypothetically, over, you know, looking back in hindsight, you would have made more money. Is it going to continue that way in the future? I don't know. But again, if you want to do a bit more work, take a look at your Friday trades. What differs them to on a Monday? You know, is there anything that stands out that you can see? Because if you can tell on every single Monday trade, this happens, but it doesn't occur on a Friday, well, there you have a pattern. Explore that pattern. See why your trades aren't working on a Friday. Again, I'm going to go back to the risk barometer here. If you don't want to give up trading Fridays, which is completely fair enough, because not a lot of people like that suggestion when I say it, because they go, oh yeah, but what if Fridays turn around? Well, okay, well, to me, if this was a chart pattern, you'd be looking to short this, right? You'd be going with a trend on a Friday. It's as simple as that. Until you can prove to yourself that you are profitable on a Friday, I'd be scaling back. You do it two ways. You can implement a risk barometer, or you can stop trading it altogether. If you implement the risk barometer, again, it's about figuring out your expected value. On a Friday, it's clearly lower than on a Monday. So should you be trading the same amount of risk on those positions? I would argue not. Your expected value is way, way higher on a Monday compared to a Friday. I would be shoving those the other sides of the spectrum. Maybe this is where you add the 0.75 or the negative side to that barometer, as I was saying. So you have your baseline at 1. You have your great trades. For example, a gold trade or a crude trade on a Monday, you know, during the US session, that's where you are gold. It's your most profitable day. It's your most profitable time of the day, and it's your most profitable asset. You should be risking slightly higher compared to trading the Dow during London session on a Friday. You know, they're proven to be, albeit you're still profitable on the two of those, the three variables I've given you, you have a lower expected value. Okay, so I would be really, really keen to hear what you're going to do for that, because I wouldn't be ignoring this. I'd be trying to figure something out. So what you can also do, but I tend to think it's more effort than it's worth, but I still suggest it to some people, is you could stop trading Fridays on this account, start trading it on a demo account and trying to figure out what's going wrong. Try different things, test different things. Obviously do it on an account that doesn't really matter, which is why I'm saying a demo account, and only trade Fridays. Now, that's going to take a while, because obviously you only get one chance per week. So, you know, over a year, you're only going to get 50 odd chances to figure out what's going wrong. But that's the other alternative. But personally, I'd be looking to get a risk barometer in here, scale back on Fridays, scale up on Mondays, and really, really strike while the iron's hot, and try and, you know, sit back, take your foot off the gas when you know that you don't perform as well. It's a really interesting metric, and I love looking at that, because again, you see so much about somebody, and it can be, like I say, it can be edge related, but more often than not, it's actually the trader or behavioral patterns that cause that. So we're just jumping back to unscripted Darwin, VWNQ now. So we can see they've got 24 trades, combined 37.5% win rate. So again, it'd be great to get that up to 50% at least before we start, you know, looking at individual trades. What's good is you do have a positive payoff ratio, which is basically risk to reward of 1.2. So your average losing trade is 1.7%. Your average winning trade is 2%. So for every losing trade, you do win more on the winning side. However, you do still have a negative overall strike rate, which would mean you would need, with a negative win rate, you would need a higher payoff ratio generally, or keep your payoff ratio and just increase your win rate. Now, your average losing trade duration is 9 hours and 40 minutes, and your average winning trade duration is almost 4 times that, 1 day, 23 hours and 31 minutes. So for your, almost 5 times that. So your winners are 4.91 times the average length of your losing trades. So first glance, let's take a look. 2 trades, 1. So 4, 5, 6. 1, 2, 3, 4, 5, 6. 2, 3. Okay, so this is where expected value comes back into play. And this is so unique to every single trader. which is your duration versus your profit. So this chart basically maps out how long you're in the market and how much do you take from that trade on average. And it measures it, like I say, return of trade in pips against trade duration. So if we just take this square, for example, you see there's 2 trades where you had a return of 0 to 10 pips and was in the market from 0 to 30 minutes. Okay, so these are trades that you were in and out within 30 minutes and took 10 pips, or between 0 and 10 pips. Now, what you can see is in that time frame, which is the first 30 minutes of being in a trade, you've only won 2 positions. So you've only had 2 positive trades, whereas you've lost 3, 4, 5. Okay, so you're at a negative expected value in that time frame. When you're in a trade or in the market for up to 30 minutes, you have a negative expected value. That pattern continues until you're in the trade for at least 4 hours. So you haven't won a trade between 30 minutes and 4 hours in the past 6 months. So what I would be looking at for you is that first 4 hours of being in a trade is kind of your danger zone. That's where you generally don't win any positions. If we count up the rest, so we've got 1, 2, 3, 4, 5, 6, 7, 8, 9. So 2 winners, 9 losers. Okay, so that's I don't know the maths off the top of my head, but it's a really, really low strike rate. As soon as we surpass being in the market for 4 hours, or I should say you surpass being in the market for 4 hours, you've lost 2, 4, 5, 6, but you've won 1, 2, 3, 4, 5, 6, 7. So you've actually therefore after 4 hours, you've actually got a positive expectancy of over 50% because you've won 7 trades and you've only lost 6. So do you see what I'm talking about when I'm saying when you're looking at specific variables, you're actually finding out that you have a different expected value within that specific variable. So again, time in the market. You're clearly a swing trader. You like letting moves play out. So within the first 4 hours, you should be looking at every single trade now and going, is there something that happens within the first 4 hours of being in the market that I can take advantage of and, exit my trades early, or know that this is going to be a winning trade? And if there is, you can even trade against that. So you can, let's say within the first 4 hours, you notice that 70% of your losers have a bullish or bearish engulfing on the H1 against your original trade, and then they all become losers. Okay, so can we flip that on its head? If you get an engulfing candle against you, like the 70% of your losing positions did, can you exit the trade for a small loser and then trade against you, maybe using your original stop as your target, right? Because you know that you don't have a high expectancy when that specific variable happens. Right, you're under 4 hours in the market, there's an engulfing candle against you, and you've seen over the past X amount of trades or X amount of months that generally is not a good sign. Again, I can't see your trades. I'm only trying to offer up thoughts and ideas and trying to provoke something in your head for you to go, okay, maybe that's something that I can investigate. I can only see the data. So it's easy for me to stand here and go, well, maybe look at this, maybe look at that. I understand it's a hell of a lot more work than I'm kind of giving it credit for. But I'm just trying to probe and generate ideas for you to go and look at and investigate. Now, this is actually quite a decent looking metric. For the guys who come to all of my sessions, you'll know that this is my favorite statistic to track inside and outside of Darwinex, which is your maximum positive and negative excursion. I call them maximum favorable and maximum adverse excursion. My mind went blank there, but it basically measures how far your winning trades go against you before they turn into winners, and how far your losers also go against you. How far your winners run for you in your favor. So the maximum positive excursion side of things tracks how much you take off the trade. Maximum negative excursion is how much drawdown do you endure. Now, what you can see between all of your drawdown, which is the red part of the candles, on each trade, it's pretty average, right? You don't have any standout trades where you let one run against you massively, which to me shows the fact that you are disciplined. You don't make stupid, reckless decisions where you remove a stop and let a trade run further against you because you don't want to take a loss on it, for example. It's pretty standard across the board, which is always a good sign because you don't have to battle with you need to be more patient. You need to not do silly things. It's just about trade optimization. Now, on the flip side, your maximum positive excursion shows how much you took off the trade. So the main thing for me here is there's one big outlier, which is this trade over here, this gold trade here, which ran for you far more than all of your other trades did. There's two things I'd be saying about this. The first one is you only took 3% out of a 7% move. Why didn't you capture enough of that move? This is where we start looking granular. Okay, so you would need to be looking at that trade, and generally others as well if you had other examples, but again, you don't because you're an infrequent trader. But taking a look at all of these, why am I giving 50% of that trade back? Is there a specific reason? Does it happen more often than once? Or is this just a one-off where you maybe had a bad day, you trailed your stop, and then price turned and ended up taking you out at 3%? Because to me, if I was gaining 7% on each move, but only taking 3%, I'd want to know what I was doing wrong so that I could start capturing the full 7% or at least 4, 5, 6%. The other thing to note is this is kind of significantly bigger than any other trade that you've had. Why was that? Is there a specific reason? On here, I mean, these kind of don't really go much for you, so it's hard to determine. I mean, it's hard to say because you've only got really 1, 2, 3, 4, 5 positions that actually ran for you. So I don't know whether you use technical areas to target, whether you use a specific risk to reward. It's too difficult for me to see. But like I say, there's a reason why this is such an outlier. There's got to be a reason why you ran this trade far longer than your other trades. For example, this trade here, also a gold trade, it ran 4% and you closed out for 3.3%. 3.32, 3.22. Okay, so it's roughly the same, which is interesting enough. Again, 3.65, 3.86. Okay, so that's interesting in itself. You seem to be taking profit around 3.5% on each position. So I'm guessing that's something that you do. I'm guessing you lock in 3% or however much it is on signal account level, and you let the trade run. But again, arguably, I'd be looking to scale it in even more because you left some on the table there, left a lot on the table over here, potentially scaling your stop more aggressively when you're running in profit. Now, what's important about this metric is I always tell people you should be tracking this outside of Darwinex as well, because whilst this is great, it only tracks whilst you're in the position. And rightly so. Your trading platform is only ever going to be able to manage record how far your trade went for you whilst you're in that trade. However, what you can do with your own eyes is look at a chart after you exited the position. Let's say on this trade here, you might go, well, the maximum positive excursion was 3.65% and I closed out at 3.65%, banging. But if it ran another 10% after that, or another 100 pips, however you track your excursions, if it ran another 10% after that, you need to be knowing about that. Because if you find that all of your winners, you're closing them out through a 3-to-1 risk to reward and taking on average 3% per trade, but they're all running 10%, I want to know why I'm missing out on 7% on each move. So you need to track this outside of Darwinex as well, ideally in your journal. I've tracked this for years. It's something that I do with every single trade that I take. I want to know how much money I'm leaving on the table. It also helps you when you're going through a rough patch psychologically. If you've taken a few losers in a row and then you start wanting to, close your next winning trade early because you've just come off of a streak of 4 losers, perhaps. If you look at your maximum favorable excursion and you see on the trade you're only up 20 pips, but your average favorable excursion is 70 or 80 pips, you should not be closing that trade. Even if it turns into a loser, there's no way you should be taking 30 pips when on average you take 80. So it's a really great trade, a really great metric to track, to improve trades, but also to keep you level-headed when, like I say, you've been through a rough patch and then you start wanting to close your winners early. On the flip side, with your negative excursion, there's 2 things that we can do with this metric, 2 easy fixes, or easy things to implement, I should say. The first one is if you notice that your winning trades are all going, let's say, I'm going to try and keep it simple. Let's say you have a 20 pip stop loss and a 40 pip target on each trade. So you have a 2-to-1 risk to reward strategy. and you know on average all your winners go against you by 10 pips. Okay, so you have a 50% maximum adverse excursion. So on every single trade, they all went against you, half of your stop size. There's two ways you can combat that. You can look at the maximum excursion. So if the maximum they went against you was 10, 11, 12 pips, and I'm only talking about winning trades here, you know that you can reduce your stop by 50% and increase your position size by 50%, or by 100%, sorry. Because let's say your stop is 20 pips, but the average that trades go against you is 10. Yes, maybe you've got some outliers that went 11, 12, 15. But let's say out of 100 trades, there was only 5 outliers. I would probably put them to the side and ignore them. I would happily take the losses on those positions to increase the payoff on the other 95 trades, for example. So I'd be looking to try and reduce my stop size. Go, on average, my winning trades go against me by 10 pips or 50 pips. So I'm going to reduce my stop to 11 or 12 pips instead of having a 20 pip stop. The other thing that you can do, but you run the risk of missing positions, is instead of bidding here, I just bid 10 pips lower or 8 pips lower. Try and get a better entry. And this works really well with a custom built metric that we've got on Darwinex, which I'll show you in a moment, where you can really work on your entries. But either way, I think your maximum negative excursion or your negative excursion as a whole, I would go out as far as to say it's the one metric that can turn any system or can improve any trading strategy, no matter how much experience or time you've got under your belt. It's the one metric, in my opinion, that can change a losing strategy or a break-even strategy become profitable when used right. But a lot of people don't even know that this is a metric that exists. Last thing on Darwinex Zero is your value at risk. Now, this is a work of art. It's very similar to mine. It's completely stable. You're sat at 3%, so you actually don't take too much risk, or you don't have a high value at risk, I should say. So your Darwin will probably be increasing your trade size by, 2x, maybe 2.5x, which would mean, again, going back to the session that I did before, the strategy development session, if you're trading a 10 lot, your Darwin's going to be trading a 20 lot or a 25 lot, for example, because you're operating under the standard value at risk of 6.5%, which is what we mirror your trades to at Darwin level. The main thing with this is that you keep it consistent, because if you're consistent, the risk engine can consistently or have a more accurate gauge on how to consistently mirror your trades at Darwin level without any variance in risk or variance in position sizing. So this is fantastic. It's better to have a consistent value at risk than a high or low. People always ask, what's a good value at risk? What's a good number? All I say is it's better to be consistent. I can't give you a number that's good or bad. Just aim for consistency. So now we're going to jump over to Darwinex. For those who don't know, you can actually view your Darwinex Zero Darwins on darwinex.com. You get access to a lot of the same information. A lot of the metrics will skip because we've already done them on Darwinex Zero. However, you do get access to more. So there's more things that you can take a look at. So if we take a look over here, you can see we've got these little circles, which are our investable attributes. So these measure different variables of your trading strategy and give them a score out of 10. And you see the lower scored ones are red, the higher scored ones are green, medium is yellow or amber, and you can see the number corresponds to how full the circle is. Now your first metric is experience. Now this is a weird one, because this doesn't necessarily tell you whether you're a good or bad trader or whether you've got edge. All it is measuring is how much data do we have on you as a trader. Because remember, you're on our investor marketplace, so you're basically being pitched by our marketplace to potential investors. Now, we need to tell them how confident we are in your trading strategy. If you have a low number of trades, or maybe your track record's a week old, obviously we can't say for sure that what you have produced thus far is going to be accurate for the next 10 years. And therefore, you're going to have a low experience score. It's nothing negative about you as a trader. It's just we cannot accurately say, yes, this guy is going to continue performing this way for the next 5-10 years. Generally, over time, the more trades that you take, or the longer you build your track record, the better. I've just realized, is your return just different? 7.38. Maybe that's not updated. One of them seems to have not updated. I think it's this one. Sorry, I just noticed that. I can't remember where I was now. The only thing I will say for the majority of people, experience isn't a metric that's going to put investors off. They're not going to be looking at you going, oh, this guy's only got a 1 or a 2 on experience. They're going to be looking at your performance. They understand that, you know, although your experience score might be low, you might have been a trader for the past 10 years and you've only just discovered Darwinex. And therefore, that's why you've got a low experience score, because we just don't have enough data on you. So I wouldn't worry about this metric too much. Obviously, it's interesting to watch it grow over time, but it's nothing major. The next metric is an interesting one, which is market correlation. So you can see that you've actually got a 9.9 score out of this, which, to be fair, the majority of traders do have a relatively high score for this, because it's a metric that tracks your ability to trade both directions of the market. So it just measures, do you trade on the long side better than you trade on the short side? If you do, there's going to be a discrepancy, and therefore you would only be able to trade one market, or you would be trading one market cycle better than another market cycle. The people who struggle with this are generally long only equities traders, so, you know, more investors. So if you've got a portfolio with US stocks only, for example, and you're buying them all, obviously you're going to have a much lower market correlation score, because whilst you might perform great in a bull market where stocks are ramping up day after day and your portfolio is just sat there without you even touching it, just increasing in value every single day, when it comes to a bear market, you're going to struggle to perform the same way that you do. If you're not able to go short with your trading strategy, you're going to struggle to perform the same. You might mitigate some losses on your portfolio as opposed to, you know, investing into an index, but as far as trading that market goes, you're not going to perform anywhere near the way you would during a bull market. So you would end up having a low market correlation score. But like I say, for the most part, most traders do have a relatively high score anyway. The next metric is just your value at risk chart. Labeled here as risk stability. Again, it's the same chart that we've looked at. Like I said, your value at risk is kind of a work of art, really, which, again, going back to your maximum negative excursion, where I said it looks like you're super consistent and super disciplined, your value at risk also shows that. So whilst I think there's improvements that can be made to your strategy, what is really clear is that you have the patience of a saint to only take 20-something trades in a 6-month period. You've clearly got the patience of a saint. You're clearly disciplined because you're not taking trades outside of what you would class as your strategy. And when you do, you're cutting them at the same time. You're not taking excessive risk on certain trades, and you're consistent with it. You know, we might look with hindsight and say, well, over the past 6 months, you haven't performed very well, but at least you've been consistent. Consistent traders are easier to improve because you can identify patterns that need to be rectified much, much easier than somebody who's a bit more sporadic. One day they're aggressive, next day they're trading a different system, and so on and so forth. So you do have a risk stability score of 9.5, which, you know, I would have probably given you a 10 looking at your value at risk chart, just because of how stable it is. Risk adjustment, this measures how often our risk engine has to adjust your trades or intervene in your trades. So generally, for the most part, the risk engine doesn't get involved in too many trades or doesn't close exposure early, especially if you've got a stable value at risk. Now, for somebody who trades a martingale, for example, they would find that they would have a high score, a really low score on the risk adjustment, because the risk engine would get involved in their trades more often. The reason for that is, let's say you're adding to your trade size constantly, the risk engine is going to be trying to mirror that at Darwin level. And whenever you're in a trade on signal account level, you're always going to be in the same trade at Darwin level. But if you're adding size and increasing your risk, that's going to be obviously up in your value at risk at Darwin level. So the risk engine might intervene to close a certain amount of exposure of a losing position. Let's say you just keep adding in drawdown. Again, your value at risk is going to increase exponentially. And the risk engine's job is to stop people. Again, for the guys who was in the last session when I was talking about what value at risk actually is, where it's about the confidence level and not losing a certain amount in each month, the risk engine will get involved to enforce that, so that we can make sure that you're not going to spiral out of control and lose an investor 10, 15, 20% in one given month, because we want to keep that maxed at 6.5% if possible. The next three metrics, no, sorry, I've jumped ahead there. The next two metrics, we have the open strategy and closed strategy. These are really interesting ones. Now, I do struggle to explain these. It makes sense in my head, but I struggle to explain it. What we do is we measure the way that you open and close positions. And what I should note is they're both available on the same screen. So no matter whether you clicked open or close strategy, you can see this chart is your open, this chart is your close. And what we basically do is we measure the effectiveness of when you open your trades and when you close your trades, and we compare it to a differential in time. So if I hover over this, let's go into a 12-month period. Oh, made no difference. If I hover over this, you can see there's a ranking. There's numbers. So there's minus 40%, minus 50%, minus 30, minus 20, minus 10, 50, 20, 40. Then it says this strategy, then 10 and 30%, and it has a ranking. What this is effectively telling you is that if you entered the market 40% sooner, you would be performing far better than you currently are. If you was entering the market at 50% sooner, 30, 20, or 10% sooner, or 50, 20, or 40% after you usually do, and it's important to know this is made of a time perspective, then you would be performing better. Now, what I should know is that this takes your average trade duration. So let's say your average duration is 10 hours, right? So if this is saying that to optimize your strategy and to perform better or get the best entries is minus 40%, you would need to be entering trades 4 hours after you, or sorry, 4 hours before your signals occurred. Now, that's quite difficult to do because, you know, if you're waiting for a specific pattern to play out and to give you a trade signal, it's very hard to retrospectively go, well, I should have been in the market 4 hours ago and I'd have had a better entry. However, what it does is if this is telling you you would be performing better by entering the market earlier, try and look at ways, okay, if I'm stalking a position on this, do I need to be more aggressive? Do I need to get into the market sooner to get a better payoff? And same with closing strategy. In fact, you know what I'm going to do? Open strategy. I'm going to put this in the Discord so that you guys can have a read of it, because I'm aware I don't always explain this the best. So if you do want to read more on this, I've posted it in the Discord chat. Alternatively, you can go to help.darwinex.com and just search for open and close strategy, and it's the open and close strategy attribute, and it will explain exactly what I mean, just in case you don't understand from what I've said in this session. This is the same with the close strategy. So it basically is going to be measuring how well you close your trades. Should you be letting them run for longer? Should you be closing them earlier? And again, this can work really well with looking at your maximum favorable excursion. If you know categorically you're leaving too much profit on the table and you're closing your trades too early from tracking your maximum favorable excursion, and then you come across to your close strategy attribute and you can see that you'd be more profitable if you stayed in the market for longer, then you know there's work to be done. You can see it from two different variables that you're not taking enough from your winning trades. Sorry, trades. I've only just seen all of these messages for some reason. Yeah, there was definitely something going wrong with my Discord chat, because I haven't seen messages for the past 30 minutes, so I've got to apologize. Anthony's not here anymore. I've got to apologize to Anthony. Sorrow Trades, really sorry, dude. I haven't seen your messages until now. Unscripted, I didn't see about your target being 1 to 2. Rob, see you later. Sorrow Trades, I can't open mine on Darwinex.com. Why is that? To view them on Darwinex.com, you have to log in. So you would have to log into your account. You can use your Darwinex 0 login, so you don't have to create a new one. And then generally just do Darwinex.com/Darwin/the Darwin, and then put a hashtag at the end. Don't know why the hashtag makes it work. Sometimes it works without, but I just always put it there. And then yeah, asked 3 times, but I figured you didn't see it. Yeah, I genuinely didn't see it, dude. Extend session, please. Yeah, we can run over, no problem. I'll also take a look at your Sorrow Trades. What I'll do, however, is I'll take a quick glance But then if you want, I'll record you a video and I'll send it to you. Probably get to do it tomorrow morning, where I'll do like a full breakdown analysis, and I'll send it to you privately. Would love the recording also. Yes, fantastic. Yeah. So it's just send me a direct message on Discord just to remind me. You'll pop up in my message request, but I'll accept it. And then I'll get around to recording a proper analysis, but we'll take a look today, because I've seen actually you've been posting on Twitter, right? And I can't remember if you're in the top 10 or top 100 or something, but you're performing really well. So it'd be great to take a look at your strategy. Asoto's also asked, can you buy more than one permanent allocation? You can't on one given Darwin. If you have multiple Darwins, then yes, you can buy a permanent allocation for each separate account. We are looking to release boosters as well, where you may be able to have multiple allocations, whether they're temporary or permanent. But I don't have enough information on that in terms of being able to give dates for when that's going to be released. But you will be able to have multiple allocations on one Darwin. Alternatively, if you do have separate accounts, you can have a permanent allocation on each one. Okay, so back to this Darwin. We've already looked at the next three, so they're the same chart between each one: positive, negative, and duration consistency. It's the same chart that we checked on Darwinex 0, which is the trading time, not the trading time distribution, the duration versus profit trade. It's just this. It's just shown in a different way. So again, position return in pips and position duration. Next is loss aversion, which again is your maximum excursions, and you do have a high score of 9, which is great. I would have also given you a high score for that because I think it's fantastic. It's clear. Again, you do have discipline and you don't let losers run too far against you. The next attribute is one of my favorites, and it's an in-house built Monte Carlo test. So basically what this simulator does is it takes your Darwin record and it compares it to 10,000 other random strategies using the same risk. So it's not comparing you to real traders. It's just a simulation generating 10,000 random strategies, all using the same risk level that you do, and seeing how you compare to those strategies. Now you can see it's measured in percentile. So currently you're in the 20th percentile. So there's a lot of room for growth, right? Now, what I would be doing with this chart specifically is as you move forward, when you make changes to your system, I would be checking how this chart reacts. It's going to be difficult for you because you don't take many trades, but for the guys who are a little bit more frequent, what I would be doing, any change that you make, come back to this performance tab and you're going to get instant feedback to see if the changes that you made were, the correct decision or not. Because you'll know if you make a change and you think it was the best thing to do in that time, but your performance starts dropping against the 10,000 uncorrelated strategies, you know that potentially you need to revert, the changes that you made, or potentially what you did was a bad change or a bad decision. Alternatively, if you make a change and then you see that you rocket through the percentiles, let's say you go from 20% to 30, 40, 50, maybe even 80, 90 percentile, you know that it was the right decision. And sometimes what you can do is if you make a small change and you shoot up on the performance chart, well, maybe you need to double down on that. Maybe it's something further to explore. If you start making slight changes and it works really well, okay, is there anything else that you can improve with that specific variable? So it's a really great chart. It doesn't give you anything to kind of walk away from and go, okay, I need to implement this or I need to change that. But what it's going to do is give you real-time feedback when you do make any changes. Now, the last one is a really, really interesting metric because, and again, the guys who come to these sessions every week will know I say the same thing about this week in, week out. Generally, your capacity as a trader is not an issue until it's an issue. Now, what do I mean by that? So the capacity attribute measures how much capital that you can manage as a trader. This is really important if you want to become a professional asset manager for the next 10 or 15 years, because you need to know how much capacity you can handle. You might waste your time building a strategy for 2 years to figure out it only can handle $50,000 and no more. you can't build a career off of that. Or if you, you know, you could do, but you wouldn't earn much money. So this becomes an issue when you're trying to scale your career and you can't, because you're held back by the amount of capital that your system can actually manage. We figure this out by measuring the toxicity flow of your orders and trying to deploy a certain amount of capital with that flow. So for example, you know, something very basic as trading in a more liquid session or more liquid time of day is obviously going to increase your capacity, because if you're trying to execute $10 million worth of orders, you need more liquidity than if you're going to execute $100,000 worth of orders. So we have to account for, are your investors going to get the same fills and the same trades and therefore the same P&L that you do as the trader? Because if you're trying to execute with your $100,000 virtual account, or if you're trying to execute with $1,000, you know, through Darwinex broker, you're probably going to get filled no problem. You'll probably get the exact price that you wanted to get. And if you're trying to exit a trade, you'll probably again get the exact price that you want to get. However, if an investor's copying your trades with 20 million, for example, like THA, for example, the most invested Darwin in the platform, if he's trying to exit a trade, he also has to consider that there's $25 million worth of investor capital also trying to exit that trade. So you need a certain amount of liquidity and volume for these guys, the investors, to get the same fills as you. Otherwise, they might get slipped. The spread might widen, and we try to account for that. So if you hit your max capacity, you won't be able to take on any more investor capital through Darwinex, because we obviously have a responsibility to the investors to make sure that their performance is the same as yours. Because again, if we're representing your strategy through our marketplace, it's on our heads to protect our investors or any investor in the platform, and also to protect you as the traders. So what we try to do is we try to keep the slippage to a minimum of 0.5 pips, or is it 0.2? I can't remember if it's 0.2 or 0.5 pips difference between the trader and the investors. And that way we know that the investors are going to get the same results as the trader. Gazebo's asked in Discord, does that mean that breaking up orders like an institutional trader does or can increase capacity? It can do. If you're trying to clip, let's say you've got $10 million worth of capital trying to enter the market. If you clip that in 10 different $1 million clip sizes, then yes, you might be able to execute with a higher capacity, because you're executing a smaller amount of orders each time. So trading with smaller size, trading more liquid assets in more liquid sessions, holding trades for longer can also increase your capacity, because you're not trying to scalp with, you know, millions of dollars worth of backing. All of these things can improve capacity. The only issue with it is I don't have a one answer fits all kind of solution for this. If you have a poor capacity, it's kind of like there's so many things that you need to test, and there's so many things that you need to do. The only thing that I could say, which could be a low hanging fruit for you, is trade higher liquid assets. For example, if you're trading exotic pairs on FX, now they've already got a fairly wide spread. If your investors are getting slipped on that as well because it's less liquid, they might get a completely different result on a trade than you do. So if you swapped Euro Swissy or, you know, pound Swissy for Euro dollar or pound dollar, you might get less slippage for the investor and therefore a higher capacity. But again, it's so no tie bar. Exactly. Yeah, no weird exotic currencies, because you will have a low capacity. I'm not saying don't trade, don't not trade you know, exotic pairs, but just be aware that you will be limited for the amount of volume that you can actually shift off in any given time, or any given trade, I should say. So let's switch to all time. This first chart measures the divergence sensitivity with each trade. Again, it evolves over time. So we can see that right now your Darwin is down 6.39%, although I don't think it's updated properly because I think it's down 7%. If your investors were getting slipped 2 pips or getting 2 pips worse fills on every single trade, which would be a no-go, the investors will be down 10%. Okay, so there's a difference of 3 or 3.5, maybe 4, because it's 6.3 to 10.3, so it's 4. That's actually not too bad. So I'm going to go out on a whim and say you've probably got a decent capacity in the tens of millions. I would be surprised if it's lower, because mine, for example, my Darwin's up 10%. And I think, in fact, let me get mine up side by side so that we can See, because my capacity is quite low and I'm actively working on finding ways to improve it. Hence why I've removed trading exotic pairs, because I used to trade a lot of exotics. The majority would be exotics. And therefore, I think that was holding me back. There we go. My Darwin's up 9.8%. But if my investors were getting slipped 2 pips, they'd be down 5.8%. So it's a 15% difference or 16% difference, which is huge. Okay. So I'm a lot more sensitive, or I have a lot more toxic flow than you do, which, you know, I trade more actively. So there's probably more chance of that anyway. And my max investment at the moment is 1.4 million. So again, it's going to be really difficult. I mean, this is just one strategy that I have. So I do trade futures outside of this. I also trade different strategies. And things like funding companies don't really come into this because you're trading demo accounts. So if I was going to professionally manage capital under this system, I would only be trading 1.5 million, and then my investors would be getting screwed, basically. But that's with a much worse score than you. Let's take a look at yours. So your maximum investment right now, okay, it's lower than I thought, but it's 5.6 million. So it's still triple or quadruple mine. It's been up to 8.85. Now, again, this is sort of an organic metric, and it will update over time. Again, yours is probably a little bit more sporadic than most, just because you're so infrequent with trading. So if you went from trading, gold or a highly liquid asset, and then the next trade was pound yen or crude, which are a little bit less liquid, for example, there might be a bigger spike in your max investment, because it's going to take into account your most recent trades as well. But like I say, it's not usually an issue until it becomes an issue. And I mean, it would be a good problem to have, where you go, oh, I'm maxed out. I've got 1.5 million under management and I can't take any more. Well, it's a good problem to have, but it's a difficult problem to solve. And like I say, I don't have a one solution fits all kind of answer. So it's something that you really need to spend some time thinking about, even if you're not going to implement anything from now. But every trader should look at this and at least understand where they stand. Because I've known traders, friends of mine actually, who've been trading with Darwinex, and then I've looked at their record and I've seen that their max investment's 200K or 300K. And I say, that really needs to be worked on, because you can't even become a 7-figure trader with your strategy, because any investors who try and back you with 7 figures, they're just going to be getting screwed left, right, and center. So it's really, really important that you understand this, even if you're not going to make any changes to begin with. Now, before we end the session, Sarah trades, I'm going to take a look at your Darwin PPWV. But I am just quickly going to look at it, and then I will send you kind of a proper breakdown. Just send me a direct message and to remind me. Return risk. Oh wow, you're number 6 at the moment. Congratulations, dude. This is great work. I've been watching your journey with Darwinex on Twitter as well. I'm the person who runs a Twitter account, just FYI for anybody who doesn't know that. So I do recognize a lot of your guys' names and a lot of your Darwins. I do have a lot of you bookmarked anyway. I'm not sure. I think I have you bookmarked already. I think of it. Yep. So I bookmarked you earlier today. So I do kind of keep an eye on the community, and I keep an eye on a lot of traders and their progress. So this is, fantastic already. Your risk-adjusted returns thus far. I mean, yes, you only started in December, so we do only have a few months to base it off, but your risk-adjusted returns are phenomenal. A 2.89% drawdown with a 16% return is absolutely fantastic. You should be super, super proud of that. Started November, slight bit of drawdown. December, decent month. Started 2025, again, a drawdown month. But then you've had a stellar February and a stellar March as well. Let's take a look at what you trade. Okay, so you're fairly active. Probably got 300 trades in total. Just one stock and ETF position. It's like a little one on his own over there. FX got 61% strike rate, indices 43, and commodities 66% strike rate. So it's a bit of a variance there. It's clear that you perform better on commodities than you do on indices, although your return would say otherwise. But again, going back to what I was talking about earlier when we was looking at the first Darwins in this session, is can you implement a risk barometer so that on the assets that you trade well, generally, you increase your size. Same with, you know, the sessions in the day and the days of the week that you perform well in. Let's break it down by assets. So NASDAQ. Okay, here's a clear example, right? Now, you don't have many trades. There's 16. There's 10 on the Dow, and then there's 6 on the NASDAQ. You haven't won a single trade on the NASDAQ, but you've won 7 out of 10 on the Dow. I would be looking at this, even now with a limited amount of data, I'd be looking at this and I'd be going, why am I even bothering with the NASDAQ? I just need to look at the Dow. Clearly something's different, whether it's a system or edge discrepancy between the two assets, who knows? Whether it's, you know, something that you do when you're looking at the system, at the assets differently. Again, I can't answer that for you, but there's a reason why you haven't won. I mean, you have overall, you have a decent strike rate, but there's a reason why you haven't won any trade on the NAS right now, but you've won 7 out of 10 on the Dow. Gold, I mean, yeah, decent. Not much more I can say about that. Again, you're on the trade optimization level, looking at your individual trades at a granular level and seeing what you can improve. Stock and ETFs, Dow. Well, dollar yen, great strike rate on dollar yen. That's a bit of coincidence. 75, almost 75% strike rate, almost 75 or 7.5% return. Just a bit of a coincidence there. This is great return, great win rate. Euro dollar, again, this is another example. So you would go, I'm presuming that you risk the same per position, but when you look at this and you do have a good sample size of trades, you've got 75 on dollar yen and 53 on EU. Your strike rate is 20% higher on dollar yen, and you've generated a much, much higher return. Should you be risking the same per asset? I would argue not. Again, I'm not saying double your risk on dollar yen or half your risk on euro dollar, but could you, add 0.1, 0.2% more risk to any dollar yen trades, specifically if it's in the sessions or the days of the week where you perform well as well? Again, going back to that point of trying to find your expected value on each individual trade by looking at all of these different variables is so key if you want to elevate and become that next level. Let's look at your different assets. So dollar CAD, again, and dollar CAD, you're underperforming, 50% strike rate, and you've actually got negative return. Dollar Swiss, again, you clearly read this market right. GU. Okay, so me looking at this right now, I'd be going, I have a few markets that I clearly read well and a few markets that I clearly don't read as well. I'd be going, I need to focus on gold, Dow, dollar yen. I'd keep euro dollar, but I would try and implement some form of risk barometer. Personally, I'd be dropping dollar CAD. I'd be, again, increasing risk slightly on dollar Swiss. I'd be removing pound dollar, and I'd also be removing New Zealand dollar. Again, this is all in hindsight, but you would have made a higher return or been pretty flat as to where you are now if you'd not traded these assets. So I always think our goal as a trader should be find a way to do less work but generate more reward. Okay, and the easiest way to do that is by identifying where you don't perform well or what assets you don't perform well on and just simply removing them. The risk barometer is a great way to combat that, but also, it gets to a point where you just go, I've traded dollar CAD 41 times in 4 months. Pardon me, I've traded dollar CAD 41 times in 4 months. I win 50% of the time. It's kind of a coin flip, but I'm actually down. Can you prove to me that over the next 4 months you can make a positive return? Because if you can't, I'd just be dropping it. Now, you can track it externally, or you can just keep cracking it on here. But generally, I'd just be like, well, does it make sense to keep trading that asset? You might want to, and that's absolutely fine. But I would be looking at it like there's just no point. I mean, alternatively, you could look at your dollar CAD positions themselves at a more granular level and see, is there something that you're doing differently on dollar CAD, dollar yen? you know, is there a variable that you always trade on dollar yen, but it's been missing on dollar CAD, and therefore you could implement to increase your strike rate and close the discrepancy between the two different assets? Or is it just that the way you view these markets are different? I know firsthand dollar CAD is a way different market to the majority of the others. You know, I haven't even looked at dollar CAD in a couple of weeks because of the structure that it's got. Whereas I've been more active on, you know, EU and GU because their structure has been better. So sometimes it is just asset specific, and you have to account for that. Snowy said, I think PPWV Darwin lot size will reduce due to increasing VAR, making it harder to perform later. Not sure what you mean by that, dude. If you could expand on that, that'd be great. Trading time distribution. So, okay, fantastic. Profitable in all sessions. There's no comment needed really here. Obviously, you know, US session is where you're most active and it's where you've generated the most amount of return. Yes, there's going to be slight deviance or slight variance in your expected value per sessions. But to be honest, with the number of trades in each session, correlates highly with the approximate return. So it's that ratio between the amount of trades you take and the return that you generate is quite consistent between all three sessions. So for me, there's not really much to pick up on there. Again, an easy one to look at is your return distribution by day of the week. You know, so they're all positive. There's not really too much to say. There's not too much discrepancy between your top day and your worst day. So your most profitable day is a Tuesday where you've generated 4.91% return for your Darwin, and the Friday is your lowest where you've only generated 1%. Okay, but is that big enough of a discrepancy to investigate? I would argue probably not. If it keeps going on this trajectory and in a year's time you've generated 3% return on Friday but a 15% return on a Tuesday, then yeah, maybe look into it, because at that point we can say you haven't just had a rough patch on the past 4 months on a Friday. It's actually a recurring pattern. Whereas, you know, after a year we can look at it and go, well, I've only made 3% on a Friday, but I've made 15% on a Tuesday. So my edge is clearly more present on a Tuesday. Would it make sense to stop trading Fridays completely and just scale up, what I do on a Tuesday? Or would it make sense to, fiddle about with it in some other way? But again, I don't know your trades. This is just what I'm looking at from kind of an unbiased perspective. I'll go over this sort of stuff privately because this is the kind of thing that takes the most amount of time. Consistency on this is phenomenal. I mean, you've started running your trades more, which is great. And it's also reflected, I mean, this increase here, so it's pretty stable. And then, you've clearly done something different, whether you've extended targets. I don't know what you've done. It's working because you've generated more of a return, but your excursion chart mirrors or matches the growth in your equity chart as well, because you can see where you started running trades, you've started making more money. I'll be interested to see how it looks on the performance chart actually since you've made that change. But yeah, super consistent on the negative side. Okay, yeah. So I see what you're saying now, Snowy. So your monthly VAR is 9.45% in Feb, but it's now sat at 15%. So generally, you're taking more risk now, whether it's the assets that you're trading, the frequency that you're trading, the position size that you're trading, or how long you're sat in the market for. The fact that you're running your trades longer now would tell me that you've got higher trade duration generally. But whether you've upped your position size too, I don't know. But this effectively means that your Darwin is now going to be replicating your trades with a lower size than it was in February, because your value of risk has increased by 5% or so. That's also counteracted by the fact that you've just made a great return. So even though you're going to be copied at a lower size, you still made a great return. But I'm gonna guess that you've increased your size and sat in trades for a longer period of time. But again, I could be completely wrong on that. So already 9.9 on the performance. So you are literally sat, and this is a bit of an ego scratcher, if you will. You're sat in the 98.68 percentile of the performance chart, which effectively means that you're outperforming 9,867 uncorrelated strategies, all running at the same risk as you, which is, like I say, it's a bit of an ego scratcher. You can say you're in the top. 98.688 percentile. So there's not many strategies, let's say, that are actually better than you or performing better than you right now. But again, like what I was saying, you was down in the mid 60s. As soon as you started running your trades for longer, which is shown by your excursion chart, look at how you rocketed through the performance or the Monte Carlo test. It's absolutely skyrocketed. I'm not going to look at all of these because I'll do this on the proper breakdown for you. But let's take a look at your capacity because it's one that I spent a lot of time talking about. So your Darwin's up 13%, but it's actually higher. So again, I don't think this is fully updated because this is shown from March the 18th, which is Tuesday earlier this week. Your Darwin's up 13%. If your investors were getting 2 pips worse slippage or worse fills on every single trade, they would only be up 1.43%. So they'd probably have like 10% of your performance. Now that's quite a big discrepancy. So again, I'm going to suggest that your AUM or your max capacity or alpha cap, whatever you want to call it, is probably similar to what I showed mine was. Take a look. Yeah, 1.95 million. So slightly higher than what I had, not as high as the other Darwin that we was taking a look at. But you can effectively manage 2 million before your investors start to get affected by the toxicity flow of your orders. Again, it's not a problem until it's a problem. 2 million is okay in terms of you'll be able to make a career out of managing 2 million. But if you carry on the way that you're going with your performance and you fill up that 2 million, you are going to want more. You're going to want 10 million, 20 million. And at that point, you're going to have to sit down and figure out what needs to change to increase your alpha cap. Now, I know Atu, the guy who runs THA, again, the one that I was talking about earlier, at the moment, he manages 25 million or 26 million. His alpha cap is about 40, and I think he was at 38 million at his peak, maybe 39 million. And he actually hired a team of quant devs to come in, analyze his system and see what improvements they could make to increase his alpha cap. Because for him, he's a full-time trader and fund manager. He needed to know, okay, how do I take more capital on? My limit is 40 million. I'm at 38. I've only got 2 more million before we kind of hit the max investment that we can take. Is there any way that we can push it to 45, 50, 100 million to take on more capital? So we're going to leave it there because we've looked at a couple of different Darwins. Sorrow Trades, send me a DM and I will do a full breakdown for you on video. That goes for anybody else too. I do these quite often for people. So I can't promise you'll get it within an hour of sending me a message, but I will always put it on my to-do list and get round to it, ideally the same week, unless it's more urgent, unless you need it quicker. But I do, generally do this for everybody who asks. I think it's really important that you will use these statistics and use these metrics to help you improve. We are here with aligned interests. I always say this, but we want our traders to succeed because we want to invest our own capital through the Darwinex fund to our traders. So it's really important for us that we give you the tools for you to improve and for you to be able to manage the capital on behalf of us and our third-party investors. So I would just encourage all of you to spend a little bit of time every day or every week, every month, going through your metrics, marrying it up to your journal. Are there any patterns of behavior that you can exploit? Is there anything that you're doing wrong or not doing so well consistently? Is there anything that you're overperforming at? And can you really put your foot on the gas with that specific variable, whether it's, again, a specific asset that you trade that you just get the flow with or get the flow for? Is there a specific day of the week that you overperform on? Sometimes you're going to look at these statistics and think, I can see that I overperform here. I have no clue why or how. I don't know what to do with it. If you're ever in that situation, speak to me. I love diving into this sort of stuff. So I'm always happy to have a conversation. Alternatively, ask Google, ask AI. If you find something, if you find a pattern in your behavior that you can't quite explain, just research it. You might find different answers. But the main thing is that not many people look at these variables. They look at technical variables only, especially retail traders. A lot of guys will can Kieran form a tribe and take in Darwin's. I'll answer that question in a moment. A lot of retail traders focus so much on technical variables that when something doesn't work, they'll start changing things, you know, from a pattern perspective or something on the charts, when really actually they need to be looking at other variables. You know, for example, what am I doing as a trader? Is there any patterns in my behavior that I need to change? Because quite often, in fact, more often than not, it's not an issue with the strategy or the technical edge that you built over time. Usually it's an issue with you as the trader. And that's nothing to be ashamed of or scared to admit. It's something you need to embrace, because if you embrace the fact that you have weak points, you can always improve them, and you can always become a better trader and improve your strategy. Now, Snowy's asked, can Kieran form a tribe and take in Darwin's under your wing? I'll ask the question, because that's a great shout. For anybody that doesn't know, we've just released the trading tribes, which is where our partners and guys trading in Darwinex era can build a tribe and have any guys join their tribe, and it can kind of act like a competition between the tribes. Snowy was asking, can I form a tribe and have people under my wing? It's a question that I'll ask. I'm not sure I'll be able to, but we'll see what we can do. I'm sure our tribe would be the best. But guys, with that, I'm going to love and leave you all. It's getting late here in the UK. It's 6:30 now, and we've been on for a lot longer than we usually do. So it's been a great session. Make sure you come to this session next week as well. If you want me to analyze your Darwin, you know, come back to that session, put your hand up. I'm happy to analyze it live. Or if you can't make these sessions, or you know you're going to struggle next week, just feel free to DM me and we can go over it privately. But guys, have a fantastic rest of your week. Well, Thursday, so have a fantastic Friday. Have a great weekend, and I will catch you all later.